Hi, and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, we are back with our favorite Vizo financial economic gurus. We have Tim Sustak, our Chief Treasury Officer with Vizo Financial, and we have Scott Wood, our Chief Investment Officer with Vizo Financial. So, Tim, last meeting of the year is coming up.
Very true.
The last meeting, the Fed lowered rates by the 25 basis points. Are we looking at another 25 basis point cut next week? And if so, why?
Yeah, I mean, in short, I think we are. I'm sold on 25 bips here at the next meeting. I think mainly for two reasons, pretty simply. One is at least the Fed speak that I've seen out there seems to indicate that they're open to it, right? I mean, there's nobody that seems to be lobbying real hard against another decrease. I mean, Michelle Bowman on the Board of Governors may be the loudest voice there, wanting to remain, cautious about reduction in rates. And I certainly think they all feel that way. I mean, with the way the economy is playing out, certainly still strong. And I think they can afford to be patient and cautious as they continue to lower rates. That said, the recent employment data that came out, the jobs data, we're creating jobs, certainly not at the pace of last year. This is a pretty good reading at 227, but the unemployment rate also bumped up from 4.1 to 4.2. So I think that kind of gives them the okay, so to speak, to go ahead and cut another 25 at the December meeting. I just feel like it'd be a good time for them to do another 25 if they want to. I think they're open to it, and I think they'll go ahead and take the opportunity.
Okay. All right. Well, Scott, do you agree with Tim? And if so, what economic indicators are you focusing on for next week's meeting?
Yes, certainly. I do agree with Tim. I think the Fed will do another 25 next week. The markets have been kind of split. In fact, a week or so ago, it was barely over 50-50.
Okay.
And in the last few days, it's become a little bit greater chance in the marketplace. When you look at Fed fund futures, they're over 80% odds now that the Fed will cut 25 basis points next week. Tim pointed out some of the obvious, things that we've been hearing. Some of the Fed FOMC members who have been speaking, they've been coming out, and for the most part, they've been in favor of continuing to look at incoming data, but while at the same time in favor of lowering rates again. Doing it this year is a good opportunity for them to cut rates one more time before the new administration is in place. And certainly Trump is not going to complain about coming in with a lower interest rate. If his first term, he was highly encouraging Powell to to cut rates. Because it helps the economy, obviously, and it's a positive thing. Tim pointed out kind of the two things that I'm kind of keen on, and we have been looking at really for the last year, and it's really both parts of the Fed's dual mandate. The employment situation, as he pointed out, ticked up a little bit last month, a tenth. We've been up back and forth on there. I think we peaked out at 4.3% 2 or 3 months ago. We've come back down. We've back up again to 4.2. So there's a little bit of that. That's kind of what got the Fed moving in the first place to cut rates, was to kind of focus more on the employment side of the equation, the maximum employment mandate they have. But the other thing we have is this week we have another CPI reading, the Consumer Price Index. So that will have a bearing on the Fed's decision next week. But more than likely, we're not going to see any big surprises there. We can see this data. The economists can see this data. So more than likely, that won't be enough to sway the Fed at this next meeting. But going forward, it's the same thing. Looking at the CPI, the PCE deflator, those are two big inflation measures, and then just paying attention to the job numbers. So the unemployment rate that Tim pointed out, and also on Thursdays, every Thursday we get that jobless claims data. That's a good leading indicator that we get on a frequent basis because it's every week. It'll let you know if the economy is, or excuse, if the employment side of the economy is starting to weaken. We'll really start to see it in there first, but probably before it starts to really have a big impact elsewhere. So we'll get a chance to see that every Thursday morning. So that's what I would continue to keep an eye on.
Okay. All right, Tim. So what do you anticipate interest rates to do over the next few months, and how will that impact credit unions?
You know what, Jamie? I don't expect them to do a whole lot actually over the next few months. I think, certainly we have the new administration coming in January. I think January meeting would be a good time maybe for the Fed to take a pause if they want to do it. And then it would put us till March before we'd get another rate action, bar some catastrophe that would cause the Fed to do an intra-meeting move, which I guess you never know with all that's going on in the world, but certainly not real likely based on what we know now. So I think it'll be a kind of a good time for credit unions to kind of reassess everything, reassess where they are in balance sheet management, what the portfolio looks like, if they have any opportunities there, both on the buy side and the sell side, if they've been kind of waiting till rates have backed off to sell some things. There might be some opportunities there too as we go forward. I know, mortgage rates backed up here just a little bit after the last jobs report. So the yield curve will still get pushed around a little bit based on the economic news that comes out. But I think, it's kind of certainly we're not going to see rates moving around, like I say, bar any catastrophe, real fast like we have, a few years back. So I think it's a good time to kind of evaluate, look at a few options, model a few things out, and be poised for you know a multitude of things, right? Because I think at this point, you just never know. Certainly, we're looking, we think, on a downward slide on interest rates. But you never know what happens with the new administration coming in and with all that's going on in the world. So a good time to take a look at both sides too. What would you do if things kind of stayed flat or things, you know, started to bump back up again? So I think a good kind of, not a lot of action time in the marketplace, so you can do some reevaluation to make sure you know what all your options are.
Well, and that actually leads into my next question for Scott. So, Scott, how might the new incoming administration affect interest rates, mortgage rates, and how can credit unions prepare?
Yeah, so there's some things that are going to come in with the new administration. There's those things that could happen, and some of these are contradictory. So it's really hard to know right now what's going to happen. So Trump is obviously a big fan of tariffs. He used them a lot in his first term. He's obviously threatened to use them again, and a lot of them that he instituted in the first term are still in place. By the way, they weren't removed. Biden kept a lot of those in place, but he's threatened to throw some tariffs on Canada and Mexico, some European folks again. Obviously, China's a big one that he talked about increasing the tariffs on them. So then you have to look at it, is this a negotiating tactic? Which it seemed like it was in the first term. It was a kind of negotiating tactic in a sense, but also, he kept these in place in a lot of them. Some of them he put on and then he removed quickly because the others, in the EU or in Canada, they reversed and they kind of came to what he wanted them to do. So he was able to remove some of those tariffs. So the tariffs have the potential, obviously, to raise prices. If prices go up, then that's going to mess with inflation numbers, and that could force the Fed to either pause for a lengthy amount of time or even potentially raise rates to get on top of inflation again, because we're teetering on that higher end of their inflation. They want to be at 2%. That's their target. We're not at 2% even. We're at, in some readings, high 2%, some slightly over 3%. So we're not where the Fed wants to be. Their hope is that we'll get there over the next, year or two, but tariffs could have the impact of causing that to go a little bit higher. Again, we'll have to see. The other part of this is the DOGE, the Department of Government Efficiency that we have. So a big issue that we have is this level of debt. The federal deficit that we have. We're paying $1 trillion a year in interest for this country, which is a crazy number. As a percentage of GDP, we're at numbers that we see in World War II. We saw in World War II when we had a war to fund. We don't have that going on right now, but we have those same levels of debt, and CBO projections are showing that level of debt is just going to, assuming Trump administration does nothing, doesn't increase spending at all, which they're planning to increase it through tax cuts and other things. That's just going to continue to go crazy, much higher than it was during World War II. So that's a big issue that the government's going to have to come to grips with. The DOGE is expected to maybe do that. What the impact will be is still to be determined. How much money can they cut? There's a lot of debate on that, on all these Different economists have different takes on it. Different government agencies have different takes on it. How much can really be cut? So we'll have to see. And then it isn't like this group can actually make the cuts. They can suggest cuts, but then Congress has to come in and make the cuts. So that's a whole different ballgame too. So we need some kind of consensus around these potential cuts. Some they could do quickly, but a lot of these are going to require the Congress to be involved. So again, these are contradictory things. On one hand, tariffs could raise interest rates. On the other hand, this Doge, if we cut some waste, some spending that isn't necessary, then potentially that could goose the economy a little bit, right, and create a little bit of heat. People are making good money and plugging along. So it's really hard to tell. I think what we've seen here over the last 3 or 4 months is the 10-year Treasury has been in a low of the low 360s up to about 440. My thinking is we'll probably continue in that range is what it will look like over the next, few years. Well, a few years is a long time. I'd say over the next year or so, we should probably stay in that range, regardless of what the Fed does. If the Fed's cutting rates or raising rates, unless we see a major move with something else out there besides what the Fed's doing with rates, we'll probably stay range bound in there. So on the lower end of the range, that's a positive for credit unions. They're going to be able to offer lower mortgage rates, which would be great for the economy, especially as we come into the spring and summer selling season this year, because last year was not super great. So that would be my hope, is that rates will continue to trend down a little bit, as Tim pointed out, and the consumers can step in the spring and start buying homes again, or even refinancing. Both of those would be a net positive for the economy.
All right. So I guess we're kind of a wait and see, but we'll be talking to you both in 25. So we'll keep an eye on this as well. So Tim, the Bank Term Funding Program, it ended back on March 11th of 24. But financial institutions, they had 1 year from that date to repay the advance. Are you seeing those repayments, and what impact is it having, if any, on liquidity?
Yeah, it's a good question. So the Bank Term Funding Program, certainly the gift last year that kept on giving. So, um, I think there's a lot of moving parts to this, Jamie. So, I mean, I guess the short answer is yes. We've certainly seen some repayments. I think there's kind of two situations here. One may be the credit union that you know actively needed the liquidity and may still need that liquidity, and for them, it's a little less rate driven, whether they're hanging on to that money or not. But I know certainly I've talked to some credit unions that are kind of managing that and, working to pay off the BTFP loan, going back to the FHLB or, other liquidity options that they have to kind of get that structured liquidity moving forward. Those that kind of sock that away for possible liquidity shortages. With the November rate drop, we kind of got to a point where that may be kind of teetering on the edge of whether that's beneficial to still hold that money or not. This is something that we've obviously been watching with our membership just to see how it would affect our liquidity situation. And the problem is with us, we have quarterly numbers. So the best we could see was back to September, and still members had about $1.5 billion on the books. But when you look at accounts and things like that, they weren't holding into the corporate, or they've since paid it off. But we've not really noticed any appreciable liquidity issues with that, either at the corporate or with our credit union struggling to figure out a way to replace that. If they still need it, at this point anyway, they've figured out a way to replace that. If you still need the liquidity and you haven't done that, I'd encourage you certainly to start working on that if you haven't. But I believe probably most have. I mean, this is as you said, Jamie, this is something that you could see coming well in advance, right? This certainly isn't any surprise. So, but overall, yeah, it has not had an appreciable effect, in a negative way anyway, that we can see on liquidity. So credit unions seem to be doing their job, migrating from one to the other if they need it. And if not, I certainly expect if we haven't seen those payments, we'll certainly see payments as we go here through the end of the year, and certainly by beginning of next. But I would suspect through the end of this year. So
Okay. All right. Well, let's look ahead. So, Scott, looking ahead, the new year, it's just a few weeks away. Do you anticipate additional rate cuts in 2025? And if so, how many are you predicting?
Yeah, that's a tough question, looking that far out. Certainly project more rate cuts next year if things continue along the path that we're on today. But I think most folks have come around, and when the Fed did their last dots plot and economic projections back, it was back in September. They were saying they were going to do 100 basis points of rate cuts this year, which it looks like we're on track to do. If they do 25 in December, we would have hit that. Projecting another 100 basis points of cuts in 2025. The 100 basis points of cuts spread throughout the year is not super aggressive in the scheme of things, and it gets them down to a pretty attractive, rate that, they hope to achieve that soft landing. Based on what we see today, I could see the Fed doing 75 to 100 basis points of cuts next year if things continue on this trajectory. We will on December 18th at their next meeting, we will get an updated projections for next year, an updated dots plot. So we'll kind of get their view of where we're heading. So I wouldn't be shocked at all if we see a little bit of a pullback there from the 100, maybe to the 75, maybe even 50. But again, 100 basis points next year is not super aggressive to me. If it keeps the economy running along, which, we have a very attractive, strong economy right now, we're still plugging along. If you look at GDP and spending and things, people are still doing that. So, no, if the economy deteriorates some, then certainly the Fed could be more aggressive. There is a lot of spending on credit cards out there, which is an area of potential concerns that credit unions should keep an eye on their membership and any stress they're feeling there with autos and credit cards. But yeah, 75 to 100 sounds reasonable to me.
Okay. All right, Tim, what about you? What are your thoughts? Do you anticipate additional rate cuts in 2025?
Yeah, I would say, Jamie, I don't really have too much to add to that. I'm in agreement with Scott. I think 75 to 100 bips is certainly reasonable based on what we know now. Like Scott said, it's not super aggressive. You certainly do 25 a quarter there, and you meet that. So based on what we know now, I can see it to me that is a nice gradual, thoughtful, drop down in rates, which is exactly what the Fed seems to be signaling they're interested in doing. So I think Scott's thoughts are right on in my book. So
All right. Okay. Well, either of you, Tim or Scott, what else should credit unions be looking at in the months to come regarding the economy and the markets?
Well,
what do you
I
think?
continue to look at the data we pointed out to you guys. The employment, obviously, the dual mandate is what the Fed's focused on. The real focus here the last 2 or 3 months or 5 months has really been the employment side of things. So they're very focused, hyper focused on the employment side. But as we mentioned earlier, with the new administration coming in with tariffs and everything, there's the potential that inflation could be an issue. And there were some that were saying inflation, we haven't really tamed inflation, and some said inflation could have been an issue regardless of that, no matter who was president, that we were going to see this natural move up again, slightly higher, maybe like we did in the, not as extreme as we saw in the late 70s, early 80s, but, following a similar pattern, how that went. So I'd keep an eye on that. Keep an eye on, as I mentioned, your members and how they are holding up to these stresses, because we have seen, especially on some of the folks that are making lower incomes, who tend to be work out there working maybe one or two jobs. There's been some stress, additional spending on credit cards, and so delinquencies for some of these folks on the lower income side of things have spiked a little bit. Auto loans, same thing. Delinquencies have spiked a little bit, so keep an eye on that. And the last thing I'll say is what Tim mentioned earlier is pay attention to investing. When you see little upticks in rates here, and if you have the opportunity, if you have the liquidity to invest, certainly grab some of those bonds that are out there, whether it's bullets or callables with long lockouts, a 2 or 3 year lockout, or it could be a mortgage-backed security with lower coupons, so it pays a little bit slower. But some of these things to lock in yield in anticipation of the Fed lowering rates, I wouldn't go super crazy because, again, there is some uncertainty, but certainly take advantage of the rates on up days, with those, and try to lock something in longer term, 3 to 5 years.
Okay. Tim, any final thoughts for our listeners today?
Yeah, I mean, I think echo what we said in the past. Make sure you're listening to what the Fed says rather than the talking heads. I think the same thing goes with the new administration coming in. Like Scott said, there's a lot of talk about what can happen, what could happen, what should happen, what the effects might be. But I think we need to keep our ears peeled to make sure we're actually listening to what is actually going on versus all the opinions out there of what could be going on. Um, so, make sure you have good sources. Make sure you're paying attention to actually what the Fed says. And like I say, I'll just go back and say I think it's a good time to, kind of reevaluate where you are with the balance sheet and come up with some options. As Scott said, you never know which way rates could go here with all that's going on in the world. We've got a lot of geopolitical tensions here, which are constantly simmering, and the new administration will likely have a different tack on how we handle some of those. So I think it's good to be prepared at this point for the possibility of rising or falling rates. So, make sure you're doing your due diligence and are prepared for either.
All right. Well, thank you both so much for taking time with me today to discuss this. Really appreciate it.
Thanks.
Thank you, Jamie.
All right, this is the final 2024 episode of Financial Minds Meet the Experts, but we'll see you again in 2025. I'd like to take this moment just to wish everyone a Merry Christmas, Happy Hanukkah, Happy Kwanzaa, Happy Holidays. I hope everyone has a wonderful new year full of happiness, health, and success. As seasons change, years come and go, but our credit union family continues to grow stronger. Hugs and kisses and New Year's wishes to you, your family, and your credit union. Thanks for listening, and make it a great day.